Hey everyone, Amber Carlson with Remax Elite. I am here with Shawn Ireland with the Bank of England, and we had lunch last week. We were talking, and it's tax time, and there are some definitely do's and don'ts before you send off that tax return. So Shawn's here to give us some tips and educate us when it's time to purchase, thinking about purchasing a home during the next few months.
Okay. Hey, thanks, Amber. Yeah. So all throughout the year, I get people coming in here ready to buy a house, and we start looking at their tax returns, and we usually find whoppers on their tax returns that generally impact the way that they can, or how much they can buy in a house. And so a lot of times I coach certain buyers to come in here before they file their taxes to maybe structure their taxes in a way that can maximize how much they can buy, how much home they can buy. So the number one thing that I see is typically the self-employed borrower. You know, they're generally going to be able to take advantage of legal deductions that the government gives them, but they generally over-deduct what they can do. And when we look at it from an underwriting standpoint, we look at your net income, not gross income. So if you take advantage of every single deduction you have and write off all your income, at the end of the day, it's going to decrease how much you can buy. There are legitimate deductions that can be added back in, like depreciation, mileage, and business use of home. So a lot of times I try to encourage people to come in here before they file their self-employed taxes. Let's look at your deductions, see if we can shift things and move things into a column that would benefit you, not hurt you. A second thing that I commonly see, and this is not for the self-employed borrower, but for your employed borrower that has business expenses, writing off too much in unreimbursed business expenses on your Schedule A. Just like with the self-employed borrower, those unreimbursed expenses will adversely affect your income, and sometimes minimizing those can increase how much you would qualify for. So I'd always encourage someone to come in and make sure you're not writing too much off on those before you file your taxes. And lastly, the biggest thing that I see is declining income. Underwriters do not like to see a decrease in income year over year from more than 10%. So if you have a suspicion that your income is going to be decreased by 10% from the previous year, whether it's overtime or bonuses or commissions or something like that, definitely encourage talking to a mortgage professional before you file your taxes to see if there's any way that you can move that income around to make sure that it looks a little bit more consistent. The way this will typically help, just to kind of translate this into a number for a borrower, is taking advantage of a $1,000 deduction on your business returns reduces your monthly income by $83 a month, which reduces your purchasing power basically by $30 a month in monthly payment. And that equates to about $6,000 in sales price.
Which is huge.
It's, yeah, huge. Yeah, absolutely. And to magnify that on a bigger scale, if you're taking advantage of $10,000 deductions, that's $60,000 in sales price. And that drastically even changes what type of house you're looking at.
True. And it's very good information. It also applies to myself being self-employed. So I just want to thank Shawn for his time and giving us that education. Talk to your local lender. Talk to Shawn if you have any questions about that. And you can find his link up above. So thanks so much for watching. Have a great day.